The vaults are empty, the algorithms have already flipped, and the world's largest banks are now trapped in a position they mathematically cannot escape. Next Monday morning, when Asian markets open, a structural event begins, not a prediction, not a theory, a calculated inevitability. What happened in 1980 with the Hunt brothers is about to repeat, but this time, it's not two men, it's millions. The charts don't lie, the data doesn't negotiate, and the banks cannot stop what's coming. The final decline before the explosion has already begun. Welcome to your John AG, where we turn complex market chaos into clear strategic intelligence. Now, if you've been in this game long enough to remember when research meant reading the Financial Times with your morning coffee, not scrolling through tweets, then you understand the value of real analysis. Do me a favor. The same way you'd save an important document in your filing cabinet, hit that subscribe button below, because what we're about to document today isn't speculation. It's evidence. And before we dive in, drop a comment. Tell me where you're watching from. New York? London? Mumbai? Dubai? I want to know who's paying attention while the rest of the world is still asleep. Right now, at this exact moment, silver is trading at $90 per ounce. To most people, this is just another number on a screen. But to those who understand market structure, this number represents something far more significant. A technical pattern has formed over the past 5 years, a pattern that appears only once in a generation, and last week, it completed. Professional traders call it a cup and handle formation. In technical analysis, this pattern is considered one of the most reliable bullish signals a market can produce, and when it appears in a commodity market with structural supply problems, the results are rarely small. Here is how the pattern works. First, the cup forms slowly, over years, as the price builds a foundation, testing support levels, absorbing selling pressure, creating what technicians call a base. Then comes the handle, a final consolidation period, a moment of calm where the market gathers energy, where weak hands exit, and strong hands accumulate. The breakout occurs when price pushes through the rim of the cup with volume. And that is exactly what happened last Tuesday, during Asian trading hours, when most Western traders were still asleep. The algorithms noticed first. These are not human traders making emotional decisions. These are mathematical systems, designed to detect patterns across thousands of markets simultaneously and execute orders in milliseconds. And they switched from sell signals to strong buy signals. The shift happened across multiple exchanges at once. Tokyo, Hong Kong, Singapore, all showing the same mathematical conclusion. When institutions program these systems, they understand what a 5-year pattern breakout means, especially when it comes with volume confirmation. History provides the context. Cup and handle breakouts often result in price movements equal to the depth of the cup itself. This is not theory. This is documented pattern behavior observed across decades of market data. In this case, the depth of the cup measures $70 from the bottom of the base to the breakout point. Add that $70 measurement to the current breakout level of $80, and the mathematics points to $150 per ounce. This is not guesswork. This is pattern recognition based on probability. But the technical pattern is only one piece of the puzzle. Beneath the surface, something more concerning is happening, something that most retail investors cannot see, but the professionals monitor with growing alarm. The COMEX exchange, where silver futures contracts are traded, is showing inventory depletion at rates not seen since the early 2000s. Physical silver held in exchange warehouses has been declining steadily, while open interest in paper contracts continues to rise, creating what market analysts call a divergence. This divergence matters, because every futures contract represents a promise to deliver physical metal, and when the amount of paper promises exceeds the amount of available physical supply, the system becomes vulnerable to stress. Dealer positioning adds another layer of concern. According to the Commitment of Traders report, commercial banks hold concentrated short positions, meaning they have sold contracts betting that silver prices will fall. But if prices continue rising, these institutions face a choice. They must either deliver physical metal they do not have, or buy back their short positions at higher prices, creating what traders call a short squeeze. The last time this structural setup occurred with this level of intensity was in 2011, when silver climbed from $30 to nearly $50 in less than 3 weeks. But that rally ended when margin requirements were raised 5 times in 8 days, forcing leveraged traders to liquidate and breaking the technical pattern. The difference today is that the underlying supply deficit is worse, industrial demand is higher, and the concentrated short positions are larger. The pattern has completed, the algorithms have repositioned, and the structural vulnerabilities are documented. What happens next depends on one critical factor: whether the physical supply can meet the paper demand when delivery requests begin arriving, And that answer will reveal itself in the coming days. The technical foundation is set. The mathematics point to $150, and the market structure shows fragility. But technical patterns do not exist in isolation. They interact with fundamental supply and demand dynamics, and that is where the story becomes even more compelling. In the mountains of Peru, at 5,000 meters above sea level, mining engineers are facing a problem they cannot solve with technology. The silver ore they extract today contains half the silver content it did 10 years ago. This is not a Peruvian problem. This is a global reality, and it is about to collide with a demand surge that most analysts have badly underestimated. While traders watch price charts, the physical world operates on different rules of geology, chemistry, and time, and those rules cannot be negotiated. Here is what the data shows. Global silver mine production currently stands at approximately 880 million ounces per year, but that number hides a critical vulnerability. 70% of that silver does not come from primary silver mines. It comes as a byproduct from copper mines, zinc mines, lead mines, which means silver supply is not controlled by silver demand. It is controlled by the economics of entirely different metals. When copper prices fall, copper mines reduce production, and silver supply drops as a side effect, regardless of how high silver prices climb. This structural dependency creates a supply response lag that most market models ignore. But the supply constraints go deeper. The major silver-producing nations, Mexico, Peru, China, Australia, have not discovered a world-class silver deposit in over 15 years. Mining executives will explain why. Exploration budgets were slashed after the price collapse of 2013. Junior mining companies went bankrupt by the hundreds, and the projects that survived now face permitting timelines that stretch 7 to 10 years from discovery to first production. Even if a major new deposit were discovered tomorrow, it would not produce a single ounce until the early 2030s. The pipeline is empty. Meanwhile, on the demand side, a revolution is unfolding in silence. The photovoltaic solar industry, which manufactures solar panels, currently consumes 150 million ounces of silver annually, nearly 20% of total global production. But here's what matters. China, India, the United States, and the European Union have all committed to massive solar installation targets for 2025 through 2030. Targets that require silver consumption to double, possibly triple, from current levels. Each solar panel contains approximately 20 grams of silver, and despite years of research into thrifting technologies, no substitute has been found that matches silver's electrical conductivity and corrosion resistance. The solar industry alone could absorb the entire annual mining surplus, leaving nothing for other industrial users. And solar is not the only sector accelerating demand. The electric vehicle transition requires extensive charging infrastructure, and every charging station uses silver in its electrical components and circuit boards. The 5G network build-out demands silver for its superior signal transmission properties. Medical device manufacturing, water purification systems, smart grid technology, all consume silver at rates that were considered science fiction a decade ago. Add these sectors together, and the industrial demand baseline has shifted permanently higher, creating what supply chain analysts call structural deficit conditions. For the past 3 years, from 2022 through 2024, the silver market has operated in physical deficit, meaning annual consumption exceeded annual production by approximately 100 million ounces per year. That deficit was filled by drawing down above-ground inventories, stockpiles held by governments, refineries, and exchange warehouses. But those stockpiles are now approaching critically low levels. When a market operates in sustained deficit, eventually, the inventory buffers run out, and that is when price discovery becomes violent. The bottlenecks are already visible. Refineries in Switzerland and the United States are running at maximum capacity, with lead times for refining services extending to 12 weeks. Unheard of in normal conditions. Transportation logistics are strained, as industrial buyers increasingly demand physical delivery rather than paper settlement. Vault storage facilities in London, New York, and Zurich are reporting allocation challenges, meaning available space for storing physical silver is becoming scarce. And perhaps most concerning, futures market participants are requesting physical delivery at rates that exceed historical norms, testing the system's ability to actually deliver the metal that paper contracts promise. The mathematics are simple. If industrial demand continues rising, and mine production cannot respond, and inventories continue falling, then price must rise until demand is destroyed or new supply is incentivized. The question is not whether silver reaches $150. The question is whether $150 will be high enough to balance the equation. In a 40th floor office overlooking Wall Street, a risk management committee meets every Tuesday morning at 7 a.m. Their job is simple: monitor the bank's exposure to commodity markets and prevent catastrophic losses. Last Tuesday, the head of precious metals trading walked into that room and delivered news that changed the tone of the entire meeting. The bank's silver short position, which had been profitable for 18 months, was now underwater by $200 million, and the bleeding had only just begun. This scene is repeating in conference rooms across Manhattan, London, and Zurich, because the largest banks in the world are trapped in positions they cannot easily exit. And the mathematics of their predicament are about to become public knowledge. Here's what the data reveals. According to the Commitment of Traders report, published weekly by the Commodity Futures Trading Commission, commercial banks collectively hold net short positions in silver futures exceeding 400 million ounces. To put that number in perspective, that represents nearly half of total annual global mine production, concentrated in the hands of fewer than 8 institutional traders. This level of concentration creates what market analysts call systemic risk. If silver prices rise sharply, these banks face margin calls, forced liquidation, and potential delivery obligations they cannot fulfill with physical metal. The last time a concentrated position of this magnitude faced a forced unwind was 1980, when the Hunt brothers attempted to corner the silver market. Nelson Bunker Hunt and William Herbert Hunt, 2 Texas oil billionaires, accumulated over 200 million ounces of physical silver in futures contracts, driving prices from $6 to $50 in less than 4 months. The response was swift and brutal. Exchanges raised margin requirements, regulators implemented position limits, and the Hunt brothers were forced to liquidate, declaring bankruptcy shortly after. But here's the critical difference between 1980 and today. The Hunt brothers were trying to create artificial scarcity. The current situation reflects actual scarcity. Industrial demand in 1980 was a fraction of what it is today. Above-ground inventories were measured in billions of ounces, and central banks still held significant silver reserves. Today, industrial demand consumes nearly 90% of annual production. Inventories have been depleted by decades of deficit, and central banks sold most of their silver holdings years ago. The concentrated short positions exist not because banks are manipulating markets, but because they sold forward production to industrial users, and now discover that production cannot meet commitments. The derivative exposure extends beyond futures markets. Over-the-counter silver derivatives, privately negotiated contracts between banks and clients, represent an additional layer of risk that does not appear in public data. These contracts create counterparty networks, where one institution's failure to deliver triggers cascading defaults across the system. And then there is the monetary policy context that makes this situation particularly volatile. Since 2020, central banks have expanded money supply at rates not seen since the 1970s, the same decade that produced silver's last major bull market. Real interest rates, adjusted for inflation, have been negative for extended periods, destroying the incentive to hold cash and increasing the appeal of hard assets like precious metals. The Federal Reserve, the European Central Bank, the Bank of Japan all face the same dilemma. If they raise interest rates aggressively to combat inflation, they risk triggering recession. If they keep rates low, they allow inflation to erode currency purchasing power. Either outcome benefits silver. Recession increases safe haven demand. Inflation increases industrial and investment demand. Meanwhile, institutional investment flows are shifting in ways that amplify the supply shortage. Exchange-traded products backed by physical silver, like the iShares Silver Trust, have seen steady inflows over the past 18 months, removing metal from available supply. Sovereign wealth funds in the Middle East and Asia are quietly allocating to precious metals, diversifying away from dollar-denominated assets. Family offices, managing wealth for ultra-high net worth individuals, are purchasing physical silver in 1,000-ounce bar form, taking delivery and storing it in private vaults. Each ounce removed from the market tightens the available supply, making the bank's short positions harder to cover. And then there is the geopolitical dimension. The technology competition between the United States and China centers on industries that consume silver, semiconductors, solar panels, military electronics. Both nations are discussing strategic metal classifications, which could lead to export restrictions from major producing countries. If Mexico, Peru, or China decide that silver is too strategic to export freely, the entire global supply chain fractures. The banks trapped short, the monetary system debasing currency, the geopolitical tensions rising, the institutional flows accelerating. All of these forces are converging simultaneously, and convergence creates acceleration. A retired portfolio manager sits in his study, reviewing position statements from 3 different brokerage accounts. He has traded markets for 42 years, survived 3 major crashes, and built wealth through careful risk management, not speculation. Tonight, He faces a decision that could define the next chapter of his financial life. The technical pattern says $150. The supply data supports it. The institutional positioning confirms it. But experience has taught him that markets do not move in straight lines. Uncertainty is the enemy of survival. This is the moment where analysis must transform into decision, where data must inform action, and where probability must guide allocation. Here is how professionals assess this opportunity. The base case scenario, assigned a 60% probability, suggests silver reaches $150 within 5 to 10 trading days following the breakout. The catalyst sequence is logical. Physical shortage becomes apparent. COMEX warehouse inventories fall below critical thresholds. Industrial buyers panic and bid aggressively. Futures traders demanding delivery overwhelm available supply. And banks covering short positions accelerate the move. Historical rally velocities in commodity markets support this timeline. Silver moved from $30 to $50 in 19 days during 2011, and market structure today shows even greater fragility. But probability is not certainty. The bull case scenario, assigned 25% probability, envisions an overshoot to $180 or even $200 per ounce. This happens if delivery defaults occur on COMEX, if a major bank fails to meet margin requirements, if retail investors globally trigger FOMO buying, creating a feedback loop that breaks all technical projections. Circuit breakers and trading halts become likely in this scenario. Exchanges implement emergency measures, and volatility reaches levels that shake out all but the strongest conviction holders. Then there is the bear case, 15% probability, where the breakout fails and prices retest lower levels. This scenario requires coordinated intervention. Exchanges could raise margin requirements dramatically. Regulators could implement emergency position limits. A large institutional holder could liquidate to meet unrelated obligations, or macroeconomic conditions could deteriorate so rapidly that industrial demand collapses. History shows this is possible. The 2011 silver rally ended precisely this way. 5 margin increases in 8 days, forced liquidation, and a 50% price decline in 2 weeks. Professional traders prepare for all 3 scenarios, not just the one they believe most likely. The manipulation and intervention risks cannot be ignored. Regulatory authorities possess tools they have used before. Emergency rule changes, position limit implementations, coordinated central banking interventions in precious metals markets. Political pressure on banking regulators intensifies when systemically important institutions face catastrophic losses. And silver approaching $150 represents exactly that kind of threat. The practical considerations determine success or failure. Current positioning at $90 per ounce offers risk-reward asymmetry. If the base case occurs, gains of 65%. If the bear case occurs, potential decline to $70, a 20% loss. But position sizing matters more than price targets. A position that represents 5% of net worth allows for conviction without catastrophic risk, allows for volatility without forced liquidation, and allows for patience during temporary pullbacks. The choice between physical metal and paper exposure depends on individual circumstances. Physical silver offers no counterparty risk, but carries storage costs, security concerns, and lower liquidity during volatile periods. Futures contracts offer leverage and liquidity, but introduce counterparty risk, margin call vulnerability, and potential delivery complications. Exchange-traded funds provide middle ground, but operate within the same system, showing structural stress. Time horizon determines appropriate allocation. A trader focused on the next 2 weeks seeks maximum exposure to capture the breakout move. An investor building generational wealth views current prices as accumulation opportunity, regardless of near-term volatility. Here's the final assessment. The technical pattern has completed. The supply deficit is documented. The institutional positioning is trapped. The monetary environment is supportive, and the probability weighs towards significant upside. But markets punish certainty, reward preparation, and respect risk management above all else. $150 is not guaranteed. It is probable. The difference between those 2 words determines who builds wealth and who learns expensive lessons. The decision belongs to each individual. The data has been presented. The countdown has already begun.